All right. So today's presentation is what the hell is a safe note? Now, we're going to be chatting about something important, right, for founders. And this is about safes. Yeah, simple agreements for future equity. When you're looking to get some funding to kickstart or bootstrap your startup, you'll come across a bunch of different ways of funding. Safes are one of those, and they become pretty popular. Now, I know they can be a bit confusing or complex if you're new to this whole thing, right? So let us see. My aim today is simple. I want to make safes easy to understand for everyone, especially if you're new to startup financing, right? So we're going to start from scratch, explaining what safes are, why you want to consider safes, and the pitfalls and red flags and things like that, right? So this is a no jargon zone. So don't worry about getting, bogged down in complicated financial terms or calculations. Now we will have a few calculations come in, but I want to make this about intuitively understanding what it is. The calculations can be done, but intuitive understanding, I think, will benefit you more. And by the end of this video, you will get what saves are all about and be able to figure out if they're the right fit for your startup. Right. So there's a little bit of a disclaimer here. This presentation is for educational purposes only and is not intended as legal or financial advice. For specific advice tailored to your situation, please contact a professional. Okay, right. So, where did safes come from? Right. In 2013, YC, that's Y Combinator, came up with a cool idea, right? They saw that a lot of new businesses were getting tangled up in something called as convertible notes. Now, convertible notes are like debt, right? IOUs that you can then turn into a piece of the company later on. But they were kind of complicated and could be a lot of headache to deal with. They took time. There was a lot of legal kind of thing involved. So YC said, why not make this a whole lot simpler? And that's how safes were born. They were designed to be a straightforward way for startups to get to the cash without all the hassle of convertible notes. Now, of course, initially they were pretty basic, but as more people started using them, it became clear that these were like powerful instruments that needed a bit of polishing. The biggest thing was about understanding how much of the company founders would give away when they turned to safes or safes turned into actual shares. Now, this is what we call dilution. It was a bit like taking a pie without knowing how much, how many slices you end up having to share. So YC introduced something called post-money safes. This was a game changer because it made it much easier for founders to see how big a slice of the pie they would give to their investors and, right from the get-go. Think of it like knowing exactly how many friends you're sharing your pizza with, so you can figure out how many slices each person gets. This new version helped clear up a lot of the confusion and made safes even more popular among startups. Now, what is a safe? Let's break it down. So let's say that you're starting out your tech company. You got this brilliant idea that you know that's going to take off. There's just one simple niggle. You need money to get things rolling. This is where safes come in, which stands for simple agreements for future equity. It's a bit like saying to investors, hey, help me out now, and I'll give you a piece of the action later on when we are more established. Now, of course, when we say later on, that is subject to some triggers, right? We call them triggers, and triggers are usually getting additional funding, prized funding, or this could be, I don't know, selling your company, it being acquired, things like that, right? There could be many triggers, and we'll talk about them when we get to that stage. So when you use a safe, you don't have to decide right away how much of the company you're giving away to your investors. That's a big deal because figuring out how much your startup is worth in the early days is as tricky as, I don't know, guessing the number of jelly beans in a jar, right? So safes let you postpone that whole what's my company worth kind of question. Typically, when you raise more money in what's called as equity financing, that is later on, it could also be called as a prized round. At that point, your startup is likely more developed and its value is clear to everyone involved, right? Okay, so what is a safe? Safes are all about giving you the funds you need to grow your business without the pressure of valuing your business at this time. It's a way of keeping things moving smoothly while keeping everyone's eyes on the big prize, making your startup a success. Now, let's look at the key ingredients of what a safe is, making sure it's easy to digest. We'll use some clear examples as we go along so you get a good grip on what each part means for you and your startup. The first column here is the investment amount. Now imagine you have a friend, Jamie, right? He believes in your startup and decides to back you up with some cash. So Jamie gives you $50,000. Now this amount, $50,000 in your case, is the investment amount. It's basically how much money your investor is putting into your company right now, betting on your future success. That's a no-brainer, right? That is simple. An investment amount is, these are the three components typically of what a safe agreement looks like. The main component is the investor amount. How much is this investor going to give you? The second is valuation cap. Third is discount rate. And the fourth is MFN clause. And we will look at each of those. Okay, so first is valuation cap. Now let's say you and Jamie agree that although your startup is young, it shouldn't be valued at more than $1 million for this deal. This limit is what we call the valuation cap. It's a safety net for investors like Jamie. It means that when your startup takes off, you're giving out shares. Jamie's investment gets treated as if your startup is worth no more than $1 million, even if it's actually worth more than that by that time. This way, Jamie gets a fair share for taking on an early bet on you. So, how should you think about valuating your startup? It's kind of like deciding the price tag of a painting you just made. You think it's not awesome, you know it's awesome, but how awesome is it in terms of dollars, right? That's the tricky part. This is where things get a little bit fuzzy. Valuations are more art than science, especially for new startups. It's like trying to guess how many jelly beans are in a jar without seeing it. You base your guess kind of guesswork on what you know, but there's a lot of room for best guess kind of a thing. So begins the valuation cap dance. Now, Jamie and you're telling Jamie, hey, I think our startup is going to be huge, but let's agree that it's worth $1 million right now for the sake of this deal. That's your valuation cap. It's a way of saying, even if our startup becomes the next big thing overnight, your investment will convert as if we're valued at no more than $1 million right now. Now that's a win-win because Jamie feels secure knowing that you're getting a fair deal and you get the funds without, of course, selling your soul. Now, how do you value your venture, right? When it comes to putting a number on your startup, here's the deal. Look around. What are similar startups being valued at, right? Chat with mentors, dig into industry reports, and get a feel for the landscape. It's a part detective work and part gut feeling. Your startup's value isn't just about what you've done so far, your MVP, your idea. It's also about the potential. Basic, of course. Think about your dream, your team's ability to pull it off, and how big this could get. Now, a couple of tips, right? First is be realistic. We all think our startups are going to change the world, and they will, they may not. But setting a valuation cap too high can scare off investors. It's like pricing that homemade painting like it's a Picasso, right? It could be a Picasso, but you gotta be realistic. Find a sweet spot that makes sense for where you are at right now, and of course, where you're headed. Now, investors will ask how you got this number. So have your reasons ready, like market analysis, early successes, or the tech you're developing. It's like showing your math homework, right? So show your work and show how you got that valuation. Sometimes you got to adjust your expectations based on feedback from investors. Now, know that it is a dialogue, right? It's not a monologue. So be open to negotiations. Now, valuing your startup is a mix of hard data, industry norms, and a dash of optimism about what you're building. Getting it right means not just attracting investors like Jamie, but setting the stage for your startup's growth, big growth. Now, roughly speaking, in my experience, the average equity that founders are happy to give away at the seed stage is around the 15% mark. Now, of course, it's not a rule of thumb, it's not set in stone. 15% is what I've seen. I think a lot in the market would agree that 15% is reasonable. 15% could be just one investor, or it could be several safes. You could have two, three safes, 5%, 5%, 5%, 5%, 10%, like that. Okay, so the next thing is discount rate. So let's say that a few months down the line, you decide to raise more money, and this time you're selling shares. Now, since Jamie supported you when your startup was just a bunch of ideas, you offer Jamie investment to convert into shares at a discount. Let's say it's 20%. So if new investors are buying shares at, I don't know, $10 each, then Jamie gets them for $8. That discount is Jamie's reward for jumping in early. This means that Jamie will get more shares, right? So if somebody else is buying shares at $10 and Jamie's kind of investment when converted into shares is valued at $8, he gets more shares, which is fair, which is the right way to do it. What about the MFN clause, right? MFN stands for most favored nation. Again, let's bring somebody else into the picture. Let's say Alex, another friend who also wants to invest in your startup with a safe. But Alex gets a better deal, let's say, than Jamie because you're in a pinch, right? And you need the cash fast. The MFN clause in Jamie's safe ensures that if anyone else, like Alex, gets a better deal, Jamie can opt into the same kind of terms, right? It's like having a best deal guarantee for your early supporters, especially people like Jamie, who's come in at very early stage. Okay, let's put it all together. So you've got Jamie and Alex backing your startup with some cash through safes. These safes have set the stage for how their early support will turn into shares of your company down the road. Jamie's got a clear path of getting a fair slice of the pie, right? Thanks to the valuation cap. A nice little discount for being an early believer, and an MFN clause to ensure that you're not missing out on any better deals that you might actually give out to someone like Alex who comes in later on. By now, you should have a solid understanding of what goes into a safe and how it works to balance the interests of founders like you and early stage investors like Jamie and Alex. It's all about giving your startup the runway it needs while ensuring your early supporters are rewarded for their faith in you. So the story so far, but how do founders see it? How do investors see it? For founders, think of saves as an easy button for getting money into the startup. Trust me, I have done a lot of saves in the last 3, 4, 5 years. Of course, I've had successes, I've got failures. When I say failures, this is about people, early investors. You put $50,000, $100,000 into a safe. And then when the trigger happens, so when we go for the next round, Series A, by that time, a few things can happen. Maybe the company shuts down. The business is a no starter, right? It's something could happen to it, which means you lose out on it. So yeah, I've seen my fair share. But let's see. Let's talk about how this is good for founders. You don't need to value your startup immediately, right? This is a big relief because honestly, putting a dollar amount on something that's just starting is more of a guess than anything else. Then there's how fast you can get this all sorted out. With Saves, you're not stuck in endless meetings or drowning in paperwork. It's all about getting the fence you need right now so you can keep building your dream without, kind of worrying about because it's a distraction. Think of it. Funding is a distraction. It is, and it could be a really big distraction. Okay, let's also talk about keeping things flexible. Saves let you play it cool with how you give out pieces of your company. You're not giving away the farm right now or right from the start. Instead, you're saying, let's see how things go and we'll figure out the details later on. This way, you keep more control over your startup while it's still kind of finding its feet, right? Now, there's also the big thing about legal bills. With other forms of funding, even with convertible notes, you're going to have a lot of legal bills. With safes, that is reduced because safes are simple. It's a 5-page document at most, and it's got two or three kind of important things: the investment amount, the valuation cap, a discount maybe, an MFN clause, of course, a bunch of triggers. What happens to the safe when triggers happen, right? So if it goes out of business or, things like that. That's it. And it's simple, it's straightforward. People can act on it, just sign it, and then your investor wires over the money. Done. Yes, of course, you need to have an attorney look through the safe agreement, but they're not going through reams and reams of paper. They're not, doing a lot of work. Okay. What about for investors? For folks looking to put money into the next big thing, safes are pretty sweet. First off, they get to be a part of a startup journey from the early, right? From the ground floor. They're not waiting around for the company to prove itself. So, what does that mean? It just means that if you're lucky, and of course this depends on number of safes you're going into and all that. It's not simple. I'm trying to simplify it. You could have big wins, and I did. Personally, I did. So, I've invested in 12 different startups over the last many years. Out of that, I had 4 massive exits, right? All 7-figure. And 2 of them came out of safes. 2 of them came out of regular kind of standard. So I built the business and all that. So finally I exited. But 2 came out of safes. And what is the ratio? Yeah, I probably invested in a lot of safes, but and lost in them. But the big wins in those exits, yeah. So the simplicity, right? The investors love it. There's no complex details. There is no, negotiation. There will be negotiation, but it's not really big negotiation, right? So safes keep it straightforward. You put your money in, and when the startup grows and raises more money, that's when you see, how your early bet pays off. So safes are like a handshake deal, right? They make life easier for everyone involved, letting the founders focus on building their businesses, and of course, giving investors a hassle-free way to support new ventures. It's all about making the early days of a startup a little less stressful and a lot more promising. Okay, now how do safes work? Now let's put some numbers on this and see, how it shakes out for the investor. Let's just look at an example without a valuation cap, without any discount, how it would work. Let's say the original investment is $50,000, right? And a future equity round, that's a trigger. They raise $1 million at 10 million pre-money valuation. That means this is the valuation before the $1 million came in. So it's $10 million valued before the $1 million came in. So for simplicity, just let's, as a benchmark, let's ignore any discounts or valuation caps, right? So what is the conversion? The SAFE turns the $50,000 equity investment into equity based on the valuation at this round. So if we're just looking at straight math, no valuation cap or discount, that 50,000 is now part of a company valued at $11 million, right? So you got the $10 million valuation plus the 1 million that was raised. What does the ownership stake look like? The investors' $50,000 becomes or gets them 0.45% of the company. That's, dividing $50,000 by 11 million, you get 0.45% of the company. Okay. Now, we're going to bring in valuation caps, right? So they are discounts and valuation caps. So if Alex and Jamie's SAFE had a valuation cap of, let's say, $5 million, and no other money was raised on the SAFEs, now the investor share would be calculated as if the company was only worth $5 million when they invested. So their 50,000 gets them a bigger piece of the pie, about 1% of the company. That's doubling the stake because of that cap. What about when a discount is introduced? So let's say there's 20% applied during the equity financing, right? Now, they get to buy their share at a discount, effectively getting more bang for their buck. This further increases their ownership percentage. So instead of let's say the shares are at $10, like everybody else, right? New investors coming in, they're buying it at $10 at a valuation. Alex and Jamie, they get to buy it at $8. So that gives them more shares, more value, of course. Okay. Is it all hunky-dory? Is it all good news? No, there's a catch, of course. Let's get into the nitty-gritty of what founders need to watch out for with SAFEs. Even though they're super handy, there's a few red flags that you don't want to ignore. And this is where I think this session is really going to start taking off. Because so far, these are basics, right? You know about it. There's tons of videos out there with a lot more math, a lot more calculations, and all that. I just wanted to set the stage. Let's now talk about the important things, and I'll bring in my experience and what I've seen and all that into this. Now, sometimes founders get a bit excited with the cash coming in and forget that when SAFEs convert to equity, it can dilute their ownership. Imagine if you weren't ready when Alex $50,000 suddenly turned into a chunk of your company. That's during the next round. It's like inviting someone to share your pizza, then realizing too late that you just left with a tiny slice, right? Then there's the cap table. That's the list showing who owns what in the company. When SAFE start converting, especially if there are a bunch with different terms, it can get messy. Keeping track of who owns what after each founding round can be a headache, making your cap table look more like a complex puzzle than a clear picture of ownership. Now, of course, SAFEs can be a great tool for fueling startups, offering a straightforward path to early funding. But like anything, it pays to pay attention, to keep your eyes open, aware of how it will play out in the long run, especially when it comes to keeping a clear head about your company's ownership and keeping the cap table kind of tidy, right? What about overuse? This is very interesting, and I've had lots of experience with founders who sort of open up 10, 5, 10 SAFEs. So imagine Alex and Jamie, right? Okay, no. Let's just say that you've now got Alex and Amy SAFEs coming in, right? They're fantastic. You got the money in. You're like doing it, and what if you realize that you need more money. The temptation is, of course, go for more safes because the first round, it was fantastic. It's, money is coming in, and you know what, you're not really worried about giving away equity, or at least that's what you think. But then think of it like this: a safe is a promise of future ownership to investors, right? Just because it's easy doesn't mean that it doesn't have consequences. Now, that's the consequence is dilution, right? When it's time to convert these kind of agreements into equity, you're left with a much smaller piece of the pie than you expected, right? It's like inviting a lot of friends to share your pizza. And then at the end, you see that you have one slice or half a slice, right? You got to be very careful. Overuse, dilution. Now, let's talk about future dilution, right? So, let's say you knew dilution was a thing, but you didn't really crunch the numbers, right? You thought we're growing, our valuation will be sky high, so a little dilution won't hurt. So, you raise, I don't know, $500,000 with safes, thinking you would keep most of the company. But when you hit the big equity round, the trigger event at, let's say, $5 million, right? Valuation, not as high as you hoped, the dilution from these safes will hit you hard. You had to give up way more equity than planned, shrinking your ownership significantly. It's a bit like planning to fill, I don't know, you're going on a trip, right? So you want to fill your gas tank, you're taking a road trip, but then you realize that your money only gets you half the tank. Now, suddenly, you're not going as far as you thought, right? Okay, dilution. Watch out for dilution. Next is having clear terms. Now, founders are usually very excited to get their safe signed, and they usually don't pay close attention to the terms. They think that all safes are pretty much the same. Hey, they're not. Remember, all safes are not the same. It's simple document. Yes, you don't need much legal kind of you know uh, wrestling, but you do need to be careful because look, let's say, for example, that one of your safes has a super low valuation cap and another has a heavy discount rate. When these are converted, yes, the terms will be more favorable to the investors than you expected, right? It's like signing a phone plan without reading the fine print, and then you're looking at unexpected charges down the line. Now, you're paying for it by giving away a lot of equity, right? There's always a price to pay, so you just have to be watchful. How is it looking? Are we still live? Can everybody hear? Okay, let me know. By the way, if you have any questions, yeah, this is live. If you have any questions, just put them in there, and then at the end of this, I will sort of go through these questions, and then we'll see. So, what are the big lessons for founders, right? Safes are fantastic tools, but don't go overboard. Keep a close eye on how much of your company you're promising away. Understand how future rounds will dilute your ownership. And always, always read the fine print. It's all about striking the right balance to fuel your growth without losing sight of your stake in what you're building, right? That is important. Your stake in what you're building. Let's look at some practical tips, right? Let's, about valuation caps and figuring out just how much money to raise with safes. Think of valuation caps like setting a limit on how much you're willing to pay for a, I don't know, vintage comic book, right? You want it, but you also want to make sure you're not overpaying, even though you may think that, the value is going to skyrocket. So, like a vintage comic book, let's say it's in sealed condition. Yeah, in next year, it's going to be more valuable. But you got to make sure that you're not paying so much that next year, what you paid is more than what it's going to be valued at, right? So that is very, very important. Now, of course, it's tempting to set the valuation, cap sky high, right? Determining like, I don't know, thinking that your startup, is going to become the next big thing. Look, here's the catch. If you set the cap too high, savvy investors might back off, right? Thinking they're not getting a fair handshake here. Because look, they're thinking, okay, I'm going to be valued at this. So the kind of valuation cap is going to be really high. Let's say that you're considering, I don't know, setting the cap at $10 million, dollars, right? But your startup is still in the beginning. You're like in the idea stage without much else to show. It's like trying to sell a car in pieces, right? But you're promising that once in the future, when you put it together, it's going to be a Ferrari. Investors might not see the potential and the return on their investment. So you need to get real. Talk to mentors. Look at what similar startups are valued at and settle on more of a grounded cap that reflects your current stage, like maybe, I don't know, $1 or $2 million. Now, these are all rough numbers, right? Examples. Now, this cap makes investing in your startup more appealing, as investors can say they can see a clear path to a kind of a worthwhile stake in your company. Now, how much to raise, right? It's like planning a road trip. Sure, you could, fill your car with snacks and, gas to the brim. But is that necessary? Are you doing a coast to coast or are you just driving to the next town? You know, you could try and raise as much money as possible, thinking that more cash equals more progress. But remember, each dollar raised with a safe, well, with other things, yes, but even with a safe, is a promise of future ownership, right? So if you raise too much and you could dilute your ownership more than you would like. Just remember, there's a trigger event and safes convert, right? Safes convert. And that's when you'll get the nasty kind of surprise, right? Let's say now that you decide to calculate just how much you need to hit the next milestone, like maybe, I don't know, finishing your app prototype and maybe getting some initial users. That kind of approach keeps your fundraising target and efficient, right? So you're avoiding the temptation to overfill the tank and face the consequences of too much dilution later on. Setting realistic valuation caps and carefully planning safe amounts are about finding the sweet spot. It's about balancing ambition with realism and ensuring that when you invite investors to join your journey, everyone's clear on the destination and how you plan to get there. Okay, let's look at the next slide. Yes, future funding, right? When planning for future funding rounds, it's crucial for founders to think about how their early use of safes fit into their larger financing strategy. Let's look into why this matters and how to do it right. First up, timing. So you've used safes for your initial cash boost, right? Which was great for getting started without diluting your ownership too much. But as you look ahead, and you need to think about when you will go for more traditional funding rounds like Series A, how these safes convert during those rounds. That is the key. That is what you need to be always thinking about. You should aim for your next big funding round at a time when your startup's valuation will clearly reflect the growth and potential that the safe investments help achieve, right? This helps ensure that when the safes convert to equity, it's at a valuation that's beneficial to both the founders and early safe investors. Integrating safes into a broader financing kind of strategy is a balancing act. It needs a thought process, it needs maybe a little bit of expertise. So you need to consider how much your company you're planning to give out and what is your threshold of that equity, dilution, right? Okay, balancing act. Yes, if you're giving away too much of, I don't know, like a super low valuation cap, you might find yourself giving away kind of a bigger chunk of your company, and it's going to come back and haunt you, right? It's. I've seen so many examples of founders. At the beginning, they're getting their hands on $100,000, $200,000 very easily, and they think, okay, it may look like 5% at that stage, but and that means they're retaining what 95%, but it quickly, and you bring on another safe, goes to 90%. When Series A comes in and everything starts converting, and then there's the post money valuation, there's this, there's that, there's discounts. Yeah, it's not going to be 90%. Yeah, you might look at it down, it might be like 70% or something. Or it could be even worse, depending on Series A and, how that looks. Okay. Uh, Communicating with future investors, yeah, just be prepared that you want to look at future investors. They need to look at your safe, and they need to be comfortable with what your safes are, and of course plan for conversion and all that, right? Okay, how are we doing for time? I think we're okay, right? I think we're okay. All right. So I'm looking to see if there is any questions. Are there any questions? Have they come in? Shall we do a Q&A? Let's go to Q&A. Okay. Right. What are we looking at? Q&A. All right. Pasan. Yeah. Thank you for that question. What is that? What are your thoughts on if an investor is asking for 51% and they want their own CFO, CMO, and also their own development team at a startup stage? What if the investor value is not aligned with your core values? Excellent question, Pasan. Excellent question. First of all, they're asking for 51% for what? Is this a seed stage? Are you a pre-seed? Are you a Series A? What is 51%? Unless they're co-founders, unless they're partners coming in, you know, at the beginning of this whole process. 51% sounds. I mean, give me more context, and we can try and analyze it. But 51% sounds like no. But okay, when there is a safe and they want to bring in their CFO and CMO, their own development team, I would be concerned because typically, outside investor, yeah, are they coming in on a safe? Because if they're coming in on a safe, then that's worrying. And if I was your advisor, I will say no. First of all, to 51%, and of course, to them bringing their own CFO and CMO. Why? Unless, of course, you don't have any CFO and CMO. But what does bringing on mean? Are they asking for board seats? Are they asking for, how does that work, right? So, I would say no. Have a product ready for market and tested, not coming in on a safe. Okay, this discussion is primarily about safes. So if you're talking about Series A, or if you're even seed, but they want board seats and 51%. No. Unless, what else are they bringing to the table? Are they I don't know, are they guaranteeing Series A funding? Nobody can guarantee Series A funding, but if they are, that's a red flag, right? So no, both seats, unless they are like non-standard board seats, right? So if they're just board seats as on paper, like I'm an advisor on a lot of the boards, and I just get paid. Yeah, there are some where I get some shares, but usually no equity. I'm just an advisor. How do you value a SaaS company? Okay. How do you value a SaaS company? That's a whole kind of another video, and we will do a live session on that. But just for the sake of like including it in this conversation, I would say, first of all, of course, you're looking at your total addressable market, right? TAM. So let's say your total addressable market, that means all the potential people that can become your customers, is $1 billion. right? Out of that, you need to look at realistic scenarios of how what percentage of the TAM can you target, realistically speaking. What percentage of that can you reach, realistically speaking? Then, based on that, looking at the kind of revenue that may come in, and then you have some multiples of it. That is the valuation. But again, like I said, that's just a very rough kind of description. And I don't want to go into calculations, and I want to keep this as an intuitive kind of discussion. So I'm trying to find intuitive ways of explaining it. But yeah, so random evaluations, just saying, oh, the kind of the market is $20 billion, and founders talk, especially when they pitch to me, when they pitch to anyone, I suppose, and in their pitch decks, they talk as if that $20 billion is available to take. No, no, the $20 billion market, whittle it down to the addressable market, that maybe becomes 1 billion, and then whittle it down to exactly what you can target, and so on. Okay, there's another question coming in from uh, Twitter X. Uh, what happens if a startup using safes doesn't raise future equity financing? Oh, very good question. So there's a safe, and then the safes have a trigger event, right? So a safe, as I was saying, is you're taking some money from an investor and promising to give them equity or shares in your business at a future date based on a trigger event. And this trigger event could be raising equity, more equity. And this is like pricing rounds, right? Like Series A. Or it could be you being acquired by someone, or you sell your business. Now, this question says, what if? So Jamie comes in with $50,000. Alex comes in with another $50,000. We started with $100,000. Maybe if I'm the founder, I put in some money. And then the trigger event was supposed to be Series A, but then we don't get to Series A, right? So maybe the technology changes. So let's say I come up with an idea. We're looking at Apple Vision Pro, and I come up with an idea for an app, and blah, blah, blah. And then Apple introduces that app as a native app, right? Or something changes, and this is dead in the water. What happens? If there is any cash left, then the safe holders will be paid first. So let's say out of the $100,000, there is $30,000 left. Then, depending on, of course, the kind of, if it's equal, Alex and Jamie, for example, yeah, they will each get $15,000. I'm just trying to keep it simple. Of course, there could be further, complicated terms and all that, but let's just keep it simple. They get paid first. And then, depending on how much you put in and all that, you could get a little bit, but usually not. But let's say there was no money left, then yeah, it's too bad for Alex and Jamie. But that's where they're taking a risk. Look, investing in startups, it's hang on, I'm trying to switch this off. So investing in startups it's a gamble, right? That is what you're willing to do. You're willing to part with a little bit of cash now with the hope that this company is going to take off and it's going to be valued at 10 million, 20 million down the line, 100 million, or a unicorn. And then what? You get 10x, 15x, 20x, 30x, 100x your investment. But if it doesn't work out, you lose. That's what investment is all about. All right, let's look at another question here. How do safes compare to like traditional kind of equity in terms of investor rights? Actually, safes are pretty easygoing, right? So when someone invests using a safe, they're not getting all the extra kind of voting rights or dividends and none of that, because there are no shares yet, right? So it's a safe agreement. So they're actually waiting in line to get their equity when the big round of funding comes in, the trigger event comes in. So it's a simpler setup. It works great, but no, yeah, you can get on the board like Alex and Jamie, as Pasan was asking. They're safe holders and they could get on board as advisors, for example, because most of the investments that I made, I didn't simply just hand over the cash and then walk away and then wait. No, I was always, one of my stipulations was that I was also on the board as an advisor because I want to safeguard my money, right? I want to make sure that I bring my expertise to the table, and of course, people who the companies were that came to me for investment, they were not just looking at that 50,000 or 100,000. They wanted me. It was more like they wanted me on their board. So yeah, okay. Somebody else is asking, can a startup use both safes and convertible notes? Yeah, you can. You can have safes and convertible notes, but it's a bit of juggling, right? So convertible notes are like debt. Safes are not debt, right? So when you have a safe agreement, and let's say I invest in your business on a safe agreement, I'm not giving you a loan, right? You don't owe a debt to me. It's a business investment. If it works out, it works out. If it doesn't, and all the money is burnt, then yeah, I can't say I can't call my debt. But a convertible note is like a loan, and there's all there's some, just like with any other loan, there is interest on the loan, there is a maturity date. It gets complex, and my okay, this is going to be controversial, maybe. My suggestion to early stage founders is avoid taking on external debt. See if you can wait for a safe, right? An external debt seems actually like a simpler solution. You might think, okay, let me take this $50,000 debt, a loan, and I'm going to pay 2%. I don't know who's going to give it to you for 2%, but let's just say. And then 2 years down the line, I need to pay it back. By that time, even if this doesn't work out, maybe I'll go back to my job, or I might have another venture that might hit. And then, okay, you're going to have compounding, right? Don't forget, by that time, this $50,000, you probably end up paying, I don't know, $100,000, maybe more. Maybe your situation is bad. Debt is bad. Debt is bad. Of course, if there's no other way, then yeah, I'm not saying you should never, never, never. I'm not saying that, right? It's okay. There's another question here. I think this will be the last question I'll take. What's the biggest mistake startups make when using safes? Um, yeah, I mean, I think I covered it. The biggest mistake is giving away, uh, you know, a lot of your company, not understanding what equity means, not understanding that the valuation cap, the discount, and then when the trigger happens, you get the Series A. That uh, the future valuation, that's going to dilute. It's going to keep on diluting your equity. And I've seen cases where you know founders ended up with 30%, 35%. They were like, what is going on, right? And then they looked at the calculations, and you know so yeah, be careful. um maybe I can do another session on valuation. How do you set the valuation cap for a safe, or how do you value your company, and so on and so forth. So yeah, I think that should be that's one of the biggest mistake. And of course, terms. You need to look at the terms and the triggers themselves. You need to make sure the triggers are they're fair to both parties, right? To the safe holders, and to you as a founder. But equity is the biggest mistake. Valuation cap, the discount. Don't jump, just giving away discounts and things like that. All right, folks. I think that's about it for now. Um, it's been a good session. Let's end this session here, and I'll see you on the next one.